పంజాబ్లో అంతా అయ్యే.
General Studies, Mains, Paper I. B. Recapitalization, 2017. Government of India announced recapitalization of PSBS to the tune of 211 lakh crore in October 2017, through infusion of capital by the government and raising of capital by banks from the government. Apart from these policies and reforms, government also launched Mission Indradhanush in 2015 to bring out transformation in PSBs in context of appointment, empowerment, accountability and separate Bank Board Bureau, BBL, was also created. Important Committee of Banking Reform. Urjit Patel Committee on Monetary Policy Framework. Urjit Patel Committee was appointed to examine the current monetary policy framework of the Reserve Bank of India, RBI. Following are the important recommendations of the committee. The committee suggested that the Apex Bank should adopt the new Consumer Price Index, CPI, as the measure of the nominal anchor for policy communication. The nominal anchor or the target for inflation should be ESR at 4% with a band of plus 2% around it. The committee asked the central government to ensure that the fiscal deficit as a ratio to GDP, gross domestic product, is brought down to 3.0% by 2016-17. The Patel panel fight that the monetary policy decision-making should be vested with a monetary policy committee, MPC. I went on to recommend that the governor of the RBI should be the chairman of the MPC. It felt that the deputy governor in charge of monetary policy could be the vice chairman. The executive director in charge of monetary policy could be its member. It could have 2 external members. The full-time external members would have full access to information analysis generated within the Reserve Bank. Black Circle. It said all fixed income financial products should be treated on par with bank deposits for the purposes of taxation and TDS. With a sharp rise in the ratio of agricultural credit to agricultural GDP, the need for subventions on interest rate for lending to certain sectors would have to revisit it. Monetary Policy Committee, MPC. The RBI Act, 1934 has been amended by the Finance Act, 2016 to provide for a statutory and institutionalized framework for MPC, for maintaining price stability while keeping in mind the objective of growth. MPC will fix the benchmark policy rate, repo rate, required to contain inflation within the specified target level. MPC will have 6 members, 3 from RBI and 3 will be appointed by the central government. The MPC will meet 4 times a year and shall publish its decisions after each meeting. The government, in consultation with RBI, has notified the inflation target, till the 31st of March 2021, inflation target 4%. Upper tolerance level 6%, lower tolerance level 2%. Black Circle. A committee-based approach for determining monetary policy will add a lot of value and transparency to the monetary policy decision. Nachiket Moore Committee for Financial Inclusion. The Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households, headed by Nachiket Moore, sets the following goals to achieve before the 1st of January 2016. Bank accounts for all adult residents. Only a third of adults have a bank account. Deposit and withdrawal facility in a 15 minutes walking distance with 1 access point per square kilometer with 400 people. Nearly 90% of the urban areas meet this criterion, whereas less than 3% of rural areas meet the same. Black Circle term life sum assured to GDP to cross 30% in every district. This can happen only with better access to insurance and risk management products. Deposits and investments to GDP ratio at least 15%. Credit to GDP ratio must cross 10% in all districts. About 95% of urban districts and 30% of rural districts meet this criterion. Banking and inflation. 81. Inflation. Words: a unit rupee will get the consumer less goods and services after inflation than it did previously. Inflation could also be a sign that economy is growing. Further, by the 1st of January 2015, the panel recommends that all financial institutions should have a broad approved suitability. Inflation is defined as a sustained increase in the general policy. Suitability is about ensuring that level of prices for goods and services. With inflation, the clients are sold financial services that our purchasing power of the currency, rupee, falls. In other appropriate for their circumstances. Damodaran Committee on Reforms in Banking Services. The important recommendations of Damodaran Committee on Reforms in Banking Services are: 6. Deposits banks should offer no-frills savings accounts with certain basic facilities such as checkbook and ATM card without prescribing any minimum balance. All fixed deposit receipts should prominently indicate the annualized interest rate to help customers take more informed decisions. The Indian Banks Association should standardize the account opening form for all banks, similar to the one used for loans. Remittances banks should facilitate electronic transfer of the demand draft amount to the receiving institution and issue a numbered tearaway receipt to reduce time and cost. Banks should be allowed to issue prepaid cards with a maximum withdrawal limit of $50,000 every day. This will reduce customers' dependence on cash. Users of electronic bank platforms, utilities, airlines, railways, for making collections should it refers to economic condition where economic growth is offer small discounts to customers to popularize electronic payment. Types of inflation. Deflation. It is the opposite of inflation. Deflation refers to situation where there is decline in general price levels. Thus, delation occurs when the inflation rate falls below 0%. Deflation increases the real value of money and allows one to buy more goods with the same amount of money over time. Deflation can occur owing to reduction in the supply of money or credit. Delation has often had the side effect of increasing unemployment in an economy, since the process often leads to a lower level of demand in the economy. Disinflation. It refers to a slower rate of inflation. The biggest difference between disinflation and deflation is that in case of former the prices do not fall. The Indian economy in 2017 was witnessing disinflation. The rise in prices has slowed down significantly as compared to previous years. Unlike deflation, disinflation is considered a positive sign, but disinflation without economic growth can be a cause for worry. Stagflation. Loans banks should be careful while reporting a borrower as a defaulter to credit bureaus. Banks must inform the customer before making any adverse remark in credit reports. Title deeds of property should be returned to customers within 15 days of the full settlement of home loans. Banks should allow home loan borrowers to switch from fixed to floating rate and vice versa at least once during the tenure of the loan. Very slow or stagnant and prices are rising. The side effects of stagflation are increase in unemployment accompanied by a rise in prices or inflation. Stagflation occurs when the economy isn't growing but prices are going up. Core inflation. It is the inflation rate that excludes temporary, volatile factors, such as energy and food prices. Headline inflation. It refers to inflation including commodities such as food and energy prices which tend to be more volatile and prone to inflationary spikes. '82. General Studies, Mains, Paper 2. Showflation. It refers to the skew in inflation where prices of some items rise very fast while others are constant or might even be decreasing. The term appeared in Economic Survey 2010 describing the Indian inflation scenario in financial year 2009-10 when core inflation remained negligible while food inflation was high. One silver lining of such skewfiations that unless one injects excessive demand into the economy through lax monetary policy, they do not last long. Low inflation, creeping inflation. It is an inflation that is slow and unpredictable. This inflation takes place in a longer run and the range is generally in a single digit. Galloping inflation. It is a very high inflation running in the range of double digits or triple digits. It is also known as hopping inflation, jumping inflation or running inflation. It was experienced in South American economies in 1970s and 1980s. Hyperinflation. It is an inflation, which is large and accelerating, which might have annual rates in millions. In such case, not only the increase is very large, but it takes place in a very short span of time. For instance, Germany, after World War I experienced such inflation, while Bolivia experienced it in mid-1985. Such inflation quickly leads to a complete loss of confidence in the domestic currency and people start opting for other forms of money. Bottleneck inflation. It takes place when the supply falls drastically and the demand remains at the same level. Such situation arises due to supply-side accidents, hazards or mismanagement, which is also called structural inflation. Reflation. It is the act of stimulating the economy by increasing the money supply or by reducing taxes, seeking to bring the economy, specifically, price level, back up to the long-term trend, following a dip in the business cycle. It is the opposite of disinflation, which seeks to return the economy back down to the long-term trend. Causes of inflation. There are two major types of inflation based on the nature of causes are 1. Demand pull inflation. Consider the case where there is too much money in the market chasing too few goods. This typically happens when demand is growing faster than supply. This usually occurs in growing economics. A demand pull inflation can happen due to the following reasons. Demand side factors. Increased population and therefore an increased demand for goods. Increase in income levels translating to increased purchasing power. Change in spending patterns of the society. Consumerism is a state where people believe in spending more than saving. Increase in money supply and liquidity. C.G. When government borrows money from public or prints in money and spends, it leads to increased money in the market, and this translates to a depreciated value of 2p and inflation. Welfare schemes like MGNREGA can increase purchasing power of the consumers and injection C in the economy too, thus leading to inflation. Supply side factors. Foodstuff production has stagnated and is not compensating for the increased demand. Problems in supply chain and involvement of too many middlemen creating supply chain bottlenecks. 2. Cost push inflation. When the cost of raw materials increase, the cost of production experiences a rise. To remain profitable, business will be forced to increase the selling price. Increased costs can come from increased wages or higher costs of imports, etc. Increased price of raw materials. Reduced export and increased import leads to current account deficit. Current account deficit leads to a depreciated rupee, which leads to an increased spending on fuel. Thus, the cost of transportation is increased, and this leads to a cost push inflation. Banking and inflation. 83. Increased wages. Especially in the farming sector, it has been observed that MGNREGA has increased wage expectations. Increased wages increases the cost of production, thereby pushing up the prices. Depreciation of rupee. It can lead to increased costs for fuel, etc., since India imports most of its petrol and diesel. Environmental clearances. If these are not made available easily, it can lead to an increased dependence on imported coal, which could translate to higher cost of production. Measuring inflation. There are three primary ways to measure inflation, i.e., GDP deflator, WPI, and CPI. GDP deflator. GDP deflator is measured and prepared by the Central Statistical Organization, CSO, Ministry of Statistics and Program Implementation. CDP deflator is nothing but GDP at current prices divided by GDP at constant prices. GDP deflator is calculated on a quarterly basis, and hence, RBI and government cannot use it much for policy making. WPI Wholesale Price Index. WPI measures changes in price of goods in the stages before the retail level. It contains a basket of three categories of 676 goods: primary articles, fuel, light, power, lubricants, manufactured products. WPI is compiled by the Economic Advisor, Commerce Ministry. Services are not included in WPI. WPI is also known as headline inflation. The base year for WPI is 2011-12, and it is measured monthly. Consumer Price Index, CPI. CPI measures changes in price of goods from the perspective of the consumer. There can be many CPIs measured and tracked in an economy. That is because the basket of a village dweller would be different from that of city dweller. They are likely to be affected by price rise differently. Base year of CPI was revised in 2015 from 2004-05 to 2011-12. Before 2011, There were four types of CPI based on the Basker used: agricultural laborer, AL, rural laborer, RE, industrial worker, IW, urban, non-manual employee, UNME. The former three types were compiled by Labor Bureau, Ministry of Labor and Employment, whereas the last type was measured and prepared by the Central Statistical Organization, CSO, Ministry of Statistics and Program Implementation. There were different base years for each subtypes. 1. CPI, urban, it is compiled at state UT as well as at an all India level. The weighting diagram of the CPI, U, has been derived from the results of the NSSO 61st round of Consumer Expenditure Survey, 2011-12. E. CPI, rural, it is also compiled at state UT and at an all India level. The weightage diagram for this index has also been derived from the results of the NSSO 61st round of Consumer Expenditure Survey, 2011-12. Regular prices are collected by the officials of the Department of Posts. Effects of inflation. Inflation affects different people differently. When price rises or the value of money falls, some groups of the society gain, some lose, and some stand in between. Let us discuss the effects of inflation on distribution of income and wealth, production, and on the society as a whole. On business community. Inflation is welcomed by entrepreneurs and businessmen because they stand to profit by rising prices. They find that the value of their inventories and stock of goods is rising in money terms. They also find that prices are rising faster than the costs of production, so that their profit is greatly enhanced. On fixed income groups. Inflation hits wage earners and salaries people very hard. Although wage earners, by the grace of trade unions, can chase galloping prices, they seldom win the race. Since wages do not rise at the same rate and at the same time as the general price level, the cost of living index rises and the real income of the wage earner decreases. T. '84. General Studies, Mains, Paper 2. On investors. Those who invest in debentures and fixed interest-bearing securities, bonds, etc. lose during inflation. However, investors in equities benefit because more dividend is yielded on account of high profit made by joint stock companies during inflation. Inflation will lead to deterioration of gross domestic savings and less capital formation in the economy and less long-term economic growth rate of the economy. Phillips curve. Black circle Phillips curve describes the relationship between inflation and unemployment in an economy. New Zealand-born economist Phillips first put this theory forward in 1938. He gathered the data of unemployment and charges in wage levels in the UK from 1851 to 19. LLC observed that one stable curve represents the trade-off between inflation and anemia, and they are inversely, negatively relates. In other words, if unemployment decreases, inflation will increase, and vice versa. This will increase the firm's cost of production. And the high costs are usually passed on to the customers in the form of higher prices. Therefore, a decrease in unemployment has led to an increase in inflation and vice versa. Height of inflation. 10. The Phillips curve. Effects of deflation. Deflation usually happens due to a fall in aggregate demand in the economy. This will lead to businesses cutting the output levels, which will result in retrenchment, laying off of workers. Moreover, if consumers delay spending in anticipation of falling prices, economic activity falls and unemployment increases. As the value of money is increasing, it becomes difficult for debtors to repay the loan. Moreover, during deflation, firms will be having lower profits due to falling prices and will find it difficult to meet their liabilities. This might lead to greater number of bankruptcies. Consistent fall in prices may trigger deflationary spiral. As firms make less profit, they might not be willing or able to invest, which will have negative implications on the economic growth. Moreover, as firms cut costs by laying off workers, there is less income for the households and the aggregate demand might fall. Due to a fall in consumer and business confidence, the economy might fall into a deflationary spiral. The principal problem of deflation is that it leads to a rise in the real value of debt. In the early stages, low interest rates and low prices encourage borrowing, but as the real weight of the borrowing is recognized, so borrowing is reduced. Measures to control inflation. Some of the important measures to control inflation are as follows. 1925. 20. Rate of unemployment. When unemployment rate is below natural rate, GOP is greater than potential output. Create inflation. Economy's self-correcting mechanism will then. When unemployment rate is above natural rate, GDP is below potential output, self-correcting mechanism will then put downward pressure on price level. Monetary measures. Monetary measures aim at reducing money incomes. Credit control. One of the important monetary measures is monetary policy. The central bank of the country adopts a number of methods to control the quantity and quality of credit. For this purpose, it raises the bank rates, sells securities in the open market, raises the reserve ratio, and adopts a number of selective credit control measures, such as raising margin requirements and regulating consumer credit. Banking and inflation. 85. Monetary policy may not be effective in controlling inflation. If inflation is due to cost push factors, monetary policy can only be helpful in controlling inflation due to demand pull factors. Demonetization of currency. However, one of the monetary measures is to demonetize currency of higher denominations. Such a measure is usually adopted when there is abundance of black money in the country. Issue of new currency. The most extreme monetary measure is the issue of new currency in place of the old currency. Under this system, one new note is exchanged for a number of notes of the old currency. The value of bank deposits is also fixed accordingly. Such a measure is adopted when there is an excessive issue of notes and there is hyperinflation in the country. It is a very effective measure but is inequitable because it hurts the small depositors the most. Fiscal measures. Monetary policy alone is incapable of controlling inflation. It should, therefore, be supplemented by fiscal measures. The principal fiscal measures are the following. Reduction in unnecessary expenditure. The government should reduce unnecessary expenditure on non-development activities in order to curb inflation. This will also put a check on private expenditure, which is dependent upon government demand for goods and services. But it is not easy to cut government expenditure. Though spending less, this measure is always welcome, but it becomes difficult to distinguish between essential and non-essential expenditure. Therefore, this measure should be supplemented by taxation. Increase in taxes. To cut personal consumption expenditure, the rates of personal, corporate and commodity taxes should be raised and even new taxes should be levied, but the rates of taxes should not be so high as to discourage saving, investment and production. Rather, the tax system should provide large incentives to those who save, invest and produce more. Further, to bring more revenue into the tax net, the government should penalize the tax evaders by imposing heavy fines. Such measures are bound to be effective in controlling inflation to increase the supply of goods within the country. The government should reduce import duties and increase export duties. Increase in savings. Another measure is to increase savings on the part of the people. This will tend to reduce disposable income with the people and hence, personal consumption expenditure. But due to the rising cost of living, people are not in a position to save much voluntarily. Keynes, therefore, advocated compulsory savings, or what he called deferred payment, where the saver gets his money back after some years. For this purpose, the government should float public loans carrying high rates of interest, start saving schemes with prize money or lottery for long periods, etc. It should also introduce compulsory provident fund, providenti fund cum pension schemes, etc. All such measures increase savings and are likely to be effective in controlling inflation. Surplus budgets. An important measure is to adopt anti-inflationary budgetary policy. For this purpose, the government should give up deficit financing and instead have surplus budgets. It means collecting more in revenues and public debt. At the same time, it should stop repayment of public debt and postpone it to some future date till inflationary pressures are controlled within the economy. Instead, the government should borrow more to reduce money supply with the public. Like monetary measures, fiscal measures alone cannot help in controlling inflation. They should be supplemented by monetary, non-monetary, and non-fiscal measures. '86. General Studies, Mains, Paper I. Other measures. The other types of measures are those which aim at increasing aggregate supply and reducing aggregate demand directly. To increase production. The following measures should be adopted to increase production. One of the foremost measures to control inflation is to increase the production of essential consumer goods like food, clothing, kerosene oil, sugar, vegetable oils, etc. If there is need, raw materials for such products may be imported on preferential basis to increase the production of essential commodities. Efforts should also be made to increase productivity. For this purpose, industrial peace should be maintained through agreements with trade unions, binding them not to resort to strikes for some time. The policy of rationalization of industries should be adopted as a long-term measure. Rationalization increases productivity and production of industries through the use of brain, brawn and bullion. V. All possible help in the form of latest technology, raw materials, financial help, subsidies, etc. should be provided to different consumer goods sectors to increase production. Rational wage policy. Another important measure is to adopt a rational wage and income policy. Under hyperinflation, there is a wage price spiral. To control this, the government should freeze wages, incomes, profits, dividends, bonus, etc. But such a drastic measure can only be adopted for a short period, as it is likely to antagonize both workers and industrialists. Therefore, the best course is to link increase in wages to increase in productivity. This will have a dual effect. It will control wages and at the same time increase productivity and hence, raise production of goods in the economy. Price control. Price control and rationing is another measure of direct control to check inflation. Price control means fixing an upper limit for the prices of essential consumer goods. They are the maximum prices fixed by law, and anybody charging more than these prices is punished by law. But it is difficult to administer price control. Rationing. Rationing aims at distributing consumption of scarce goods so as to make them available to a large number of consumers. It is applied to essential consumer goods such as wheat, rice, sugar, kerosene oil, etc. It is meant to stabilize the prices of necessaries and assure distributive justice. But it is very inconvenient for consumers because it leads to queues, artificial shortages, corruption and black marketing. The inflation argument, good vs bad. A moderate amount of price rise is usually considered good for the economy, that is because increased prices encourage producers to produce more, thus leading to increased growth and increased purchasing power for the average consumer. Thus, while the price has risen, so has the purchasing power of individuals, so the economy has grown, but individual consumer is just as good if not better off. In the long term, this will translate to more product refinement, greater quality, etc. However, when the rate of inflation is higher than the increase in income levels for all sections or for a particular section of society, then inflation becomes terribly bad. Consider, for instance, that the price of most commodities have gone up by about 10%, but the income levels of the bottom 50% of the populace hasn't grown up at all, but that of the top 50% has risen by 20%. Here, the overall income levels have increased more than overall price levels. But the poorer sections of the society will be overburdened by the price rise. Also consider individuals with fixed incomes such as pensioners and old people living off interest on their earnings. Such individuals are also hit very hard. In the short term, high growth and high inflation can coexist. However, in the long run, inflation will dampen out growth,